Hello, everyone. Welcome to today's webinar with myself, Fawad Razaqzada, and my colleague, Victor, who you may have heard. He's back from holiday. How are you doing, Victor? Glad to have you back.
Very well, well rested and ready to rumble.
Batteries recharged, as the saying goes. I badly need a holiday myself, to be honest. Haven't been able to go anywhere because of the restrictions that are still in play in the UK, but it is what it is. Anyway, please take a moment to read the risk warning and the disclaimer on the screen. While you read that, let's just remind you that this webinar is obviously recorded for those of you who are going to be watching it live on YouTube later. But for future, please consider joining us live because you will have the opportunity to ask us questions as we discuss live charts in this webinar. So these webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that the spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So let's jump straight to the charts. In fact, before we do that, a quick reminder in terms of what to expect this week. I wrote a week ahead preview on Monday, and I think there are a few potentially market moving events happening this week. Most notably, we have the RBNZ meeting on Wednesday. Well, a rate hike was expected. However, you may have heard overnight the New Zealand government has decided to put the country in a lockdown. That's after finding one COVID case. So they want to go hard on it and fast, rather than allowing the cases to grow, then put the country in a lockdown. In the past, this strategy has worked well for New Zealand, and I think that's what they're trying to do again. The nation is going into a 3-day lockdown. Were you saying something there, Victor?
Yeah, I'm saying that New Zealand is one of the few countries that have adopted a zero cases policy. And obviously that's facilitated by its remoteness from the rest of the world.
Yeah.
However, how long they can sustain that, I'm not sure. Obviously, this is a test to their policy.
Yeah.
And Auckland actually will be locked down for 7 days. As a
7 days,
result,
yeah.
the QE has slipped almost 1.5%. I'm not sure if this is not a little bit of an overreaction, but apparently the market is starting to question the odds of a rate hike, which
Indeed.
which is widely expected for Wednesday, actually.
Yeah, so as you can see in the economic calendar, a 25 basis point rate hike was expected to lift the OCR, or the official cash rate, to 0.5%. However, after the lockdowns, a lot of analysts that cover New Zealand central bank, they now expect the central bank to hold off raising interest rates at this particular meeting. But some of those analysts still expect rates to rise to 1.25% or 1.5% by the year end. So they're expecting another 1 or 2 or 3 hikes in the next few months. But this clearly is a big risk now facing the economy, the lockdowns. If things get worse, then there is a risk that we may see only a limited rise in interest rates in New Zealand, and that is weighing on its attractiveness as for yield-seeking investors. So that's why we've seen a big drop in New Zealand dollar overnight. And where it goes from here obviously depends on what the RBNZ says. And from here, I think the big risk is actually if the RBNZ decides to go ahead with a rate hike. That would catch the market off guard now. So that's the biggest risk. But I'm not really sure what the RBNZ will do. I think it's logical for them to hold off now, as the market is expecting. But they can, they have surprised the markets before. They have they may decide to surprise the market. Who knows? But in any case, we should see continued volatility in the New Zealand dollar, providing lots of trading opportunities if you're a short-term trader. If you're a scalper, then keep an eye on this, because it could move around quite rapidly in the next few days, because we also have important data coming out from the US. We have retail sales coming in at 1:30 London time. This is going to be very important for the US dollar. Now, you may have noticed we have seen a sharp deterioration in US data in the last couple of days. On Monday, the Empire State Manufacturing Index came in quite weak at 18 when 28.9 was expected. Big disappointment there. And last week on Friday, we had a big disappointment in terms of University of Michigan's Consumer Sentiment Index, which came in at 70.2 when expectations were for 81.2. This reading, by the way, 70.2 was the lowest in a decade, lower than the height of the COVID crisis. So it's something to be wary of, because if consumer sentiment starts to turn sour as it has, by judging by this piece of data, then that could impact consumer spending, and in turn inflation, which in turn would mean that the Fed might not taper its asset purchases as fast as the market is currently expecting, which in turn could mean lower yields and higher gold, etc., etc. Sorry, Victor. Sorry to cut you off there.
That's it. Yesterday we heard from Rosengren, a Fed official, that provided that the next employment report is a solid one, whatever that means. The Fed should proceed with starting to taper in September. So Rosengren is typically on the more hawkish side. I wouldn't reach too much into his comments, but indeed, we have seen some very strong employment reports recently
in the last couple of months.
And another one would really pressure up on the Fed. That consumer sentiment number, if you ask me, a lot of the deterioration is due to inflation numbers. So if the Fed wants to reintroduce some confidence among consumers, higher rates might be necessary. I mean, at least pulling back on purchases might be necessary.
Indeed. Let's see what the next few days will bring to us. But going back to the economic calendar, just to highlight a few other things, we have like a few important UK data this week, data points as well. We had the average earnings index come in a little bit on the I was going to say softer side, but I think it came in stronger. Yeah, it came in a little bit stronger, but this was offset by weakness in claimant count. Now, jobless claims in the UK were expected to drop by 84,000. However, it only dropped by 8,000, which was much weaker than expected. So that has hurt the pound today, sending the euro pound a little bit higher. Still, the euro pound remains in a bearish trend. We'll cover that in a minute. But we have more data from the UK tomorrow. CPI is expected to come in at 2.3%, coming down from the 2.5% reported previously. Core CPI is at 2% expected. and we have other measures of inflation. Keep an eye on PPI input and output, because these indicators will tell you how much of inflation from commodity price hikes will be will probably come into future rates of inflation, and how much of that will be absorbed by the factories. So if PPI output is only 0.5%, which is roughly where it came in the previous month, that will not be too inflationary. But if it comes in a lot higher than that, then that could be something to pay attention to. We also have CPI from Canada. Where is it gone? CPI from Canada. FOMC meeting minutes is on Wednesday as well. So there's a few things to keep an eye on. And then on Thursday, we have some important employment numbers from Australia. So if you trade the Aussie, that should be very important to you. And Friday, we'll see the release of more UK data in terms of retail sales and consumer confidence, etc. And we have the Canadian retail sales as well. But overall, you can see there's not many economic pointers on the calendar this week, which is likely to mean subdued volatility in the FX markets. But if worries about growth, were to rise further, then that could cause some volatility in FX, and we've already seen some kind of wild swings intraday on the indices. Will that translate into the FX remains to be seen. But going back to the charts now and looking at the dollar index, you can see it's bang in the middle of the range. Recently, it broke its bearish trend line, but it then formed resistance around 93.20, from where it has dropped again to go back inside the range. So the dollar index is not really telling as much, but it is above the 21-day exponential, above the 200-day moving average. So it's starting to make some higher highs and higher lows, which means that the dollar is gaining some strength. And most of the strength is because of weakness in the euro. Now, the euro has had a decent bounce in the last few days, but it's come up to the 21-day exponential again, as it continues to consolidate inside this bearish in this falling wedge pattern. It looks like the euro dollar is going to head further lower over time, given the lower lows, lower highs, the fact that it's below the 200-day average, and so on. This is because obviously the ECB has become a one of the most dovish central banks out there, while the Fed has recently been more hawkish in terms of its expectations about where interest rates are going to head to in the US. So given the diverging policies of these central banks, the euro has been falling in most cases. So this is something I drew on the chart a few days ago when I was expecting the euro dollar to test this 117 handle, which was the previous low. I say that if it breaks and holds below that level, creating a bearish candle like this, that would be a kind of a continuation of the recent downward trend, leading to further weakness in the days ahead, possibly towards 115. Whereas if we get a quick rejection of that level and we form a hammer candle like this, then that would be a bullish scenario, which could then lead to some follow-up technical buying for the next few days. As it turned out, the euro didn't even touch the 117 before bouncing from its lows. However, that level remains exposed because you have kind of double bottom there. Lots of people who think that this may be a bottom will have placed their stops below these recent lows, meaning that the area below or around 117 is now going to be a big pool of liquidity where lots of stops are going to be resting. Therefore, if the euro shows continued weakness, let me zoom in a little bit, and we start to go back below 117, 117 now being a key short-term support level. If you go below 117.50, and hold there, then that will sharply increase the risk of price breaking down in the next few days to take out 117. So today's price action is going to be important. I think if US data comes in a bit stronger than expected, we may see the euro come down and test 117.50. And if we hold there on a closing basis, if we hold below 117.50 on a closing basis, then in the next few days, I would expect the continuation to the downside below 117 and eventually towards 116 and possibly lower over time. But we'll cross that bridge if and when we get there. In contrast, if US data retail sales come in stronger, then we may see a further recovery in this bearish trend towards the top of the or the resistance trend of this wedge and resistance around 118.30, which was the base of the recent breakdown. So that level is now the next key bearish, the next key resistance for this pair should we get there. Even if it were to get to this level, it will still not be out of the woods because obviously it will still need to create a higher high above these highs at around 119 before one could say that the bearish trend has ended. So in my view, the bearish trend is still intact, and I think the euro dollar is going to break down. It just needs a little push to get us to these levels next. Obviously, I'll be wrong if it goes above 119. That's my line in the sand for the euro dollar. And similar picture, across the board. If you look at the likes of the Aussie, the Kiwi, the Canadian dollar is another currency pair to keep an eye on because recently it broke above its above 125, which was previously support. As you can see, it created a higher high above this high before pulling back to create what looked like was going to be a bearish move, but the trend line held, and recently it consolidated around the trend line before breaking out to the upside. So this is a possible signal that the dollar CAD has resumed its bullish trend that started in June of this year. Yeah. So the level to watch in terms of support now is right here, around 125.85. Because that level was previously resistance, as you can see by the wicks of these candles, which has now been taken out. Therefore, if we get a retracement today back to this level, we may see a bounce and a continuation to initially 126.70-ish, and then eventually above the high of this candle right here. So that is the potential path that the dollar CAD may take in the next few days, so long as this dollar strength remains in place.
And just to jump in here, so
yeah,
long as the as oil prices continue to drift lower, since the Canadian dollar is closely tied to those.
Yeah, so as you can see, oil prices have been making lower lows and lower highs. There's been 3 distinct lower highs, and this is another lower high here. It's keep on bouncing from this 65, 62 level, which is last year's high, hit here in January of last year. We tried to break through this level a few times in the past, and then eventually this level gave way on 24th of May this year. Since then, we've had another big run up and then a big sell off. We broke this bullish trend line, bounced at this level once, twice, 3 times. Will it be will it be 4-time lucky for the bears? Will we get below 65, 62 on the WTI contract? It looks very likely because of macro reasons. Major economies, especially in Asia, they have had to go into lockdown again, oil-consuming nations. Demand from tourism, people have not been going on holiday that much in Europe because of continued restrictions. Despite the vaccinations and stuff like that, a lot of people, certainly in the UK, have decided not to go on holiday this year, which has had an impact on demand. Hasn't been as strong as expected for oil. And at the same time, the OPEC is continuing to ease its restrictions. Supply is coming back, and expectations that the market is going to be very tight is, those expectations are being tapered. So because of that, we have seen the rally on oil prices stall, and now we are starting to see some bearish price action on WTI and Brent charts. Let's have a look at Brent as well, because we talked about a very important monthly level in the past, which was this trend line, this red trend line connecting the previous peaks in 2008, in 2012, in 2014, and now in 2021. This trend line is really important for Brent, and before it got there, we had highlighted this trend line, saying that possibly oil could come into pressure around that level, and lo and behold, it has. Not simply because of the trend line, but obviously the fundamental reasons we just discussed. Brent is now on the verge of a drop below this level here at 67. Call that 67.50, because we have had this weekly hammer candle created a few weeks ago. We should have seen some bullish follow through. Yeah, we didn't. And instead, what happened? Price broke above the high of that candle, and it proved to be a trap for the buyers. There was no upside follow through whatsoever. And now price of oil has drifted lower. For now, it looks like it has created a double bottom, but these types of double bottoms usually fail. And so I wouldn't be surprised if Brent were to take out this 67.50 level in the next few days and head down towards 65, possibly lower in the days ahead. So keep an eye on oil prices. Now, if oil prices do go down, as Victor mentioned, then that should be bad news for the Canadian dollar, meaning it should be good news for the dollar CAD currency pair, because Canada's main export commodity is crude oil. So shall we? Well, while we're talking about commodities, let's talk about gold and silver. Gold has had a strong recovery off the lows, and this is in response to US data we mentioned coming in weak. That has caused bond yields to go down. If I show you the US 10-year, the US 10-year has gone back down in terms of yields. So when yields fall, this reduces the opportunity cost of holding gold, a safe haven commodity. So as a result, we have seen gold go up, and now it is testing key resistance between 1790 to 1797, this level here, where previously it was forming support. Will it offer resistance upon retest now? That's the key question. And a lot of what happens next will be determined by today's publication of the retail sales data from the US. If gold were to go through this resistance, then the next potential resistance area will be the 21-day, the 200-day moving average, which converges with the bearish trend line around 1810 area. So that will be the next key level of resistance for gold should it go through this potential resistance zone. On the downside, 1765 to 1750 is now going to be the key area of support, because previously it was resistance, and now it's kind of reclaimed. Yeah. So if it gets retested from the upside, then it may offer some support to prices. Overall, if I zoom out a little bit, you can see that oil has been going up and down inside this triangle pattern. So despite its sharp recovery, prices remain in a consolidation profile. Indeed, if you look at the weekly chart, it shows a very similar picture, even on this time frame. The bearish trend line is still intact. Support is still intact around 1700. We got a very nice hammer candle last week. Now, if you are bearish on gold, what you want to see is for gold to go back below last week's high. So last week's high, previous week high. Yeah, this level is last week's high, 1780. If I show you the chart of oil, we had a similar hammer candle on crude oil weekly chart a few weeks ago, and look what happened. There was not much follow through on the upside. So if oil goes back, if gold goes back below, last week's high, similar to what oil did, then that would be bearish, and that could then lead to a sharp drop back towards 1700, maybe lower over time. So that's the key risk. And when prices are in consolidations, you will see lots of traps, bullish and bearish traps, which is something that you need to be aware of. And while this does look bullish in terms of how it bounced off the lows and whatnot, just be wary of that risk. Yeah,
it can always be just a trap.
Indeed.
So from a fundamental perspective, gold has been rallying because of some skepticism that the Fed is going to be able to tighten much, and because of recent signals that inflation has been cooling.
Yeah.
That's something to keep a close eye on if you want to take this long-term view on gold, that it can rally further from current levels.
Yeah.
However, if history is any guide, this rally, which basically it's over $100, the rally, this gold bottomed out just above 1680.
Yeah.
So it's been $115 of straight up rallying, and at this point in time, we might see some consolidation before a more protracted direction is taken.
Indeed. So for me, I think above 1830 would be bullish, because we will have created a higher high there. So I'm still kind of treating this with a bit of caution. It does look quite bullish, but as it comes to test this resistance zone, and given the potential for a dollar recovery, it's we need to proceed with a bit of caution here. Let's talk about indices, shall we? And meanwhile, guys, if you have any questions on the markets that we have so far discussed, or indeed any other thing that you would like us to cover, please write it in the questions or chat window, because we like to keep this webinar as interactive as possible and relevant to you. That's why you guys join us live, right? To get our opinion on the markets that you guys are interested in. So please don't hesitate to ask us any questions you have in the questions box or in the chat window, and we'll be more than happy to answer those. European indices have been rallying really strongly of late. This is the Euro Stoxx 600, Europe 600 index. Big rally to new all-time highs. If you look at the French CAC index. I'm not sure if this is a all-time high, but it's been rallying to multi-year highs. And the German DAX, my favorite index, is also looking really strong. In the last few days, it has come off the highs because of profit taking and some concerns about the economy slowing down. But with the ECB continuing to provide lots of liquidity and stimulus, this is going to keep the market supported in Europe for a long time to come. So that means that any short-term or longer-term dips you will see in the markets, they will likely to be bought, as we've seen in the past. And this zone I highlighted in one of my reports this or last week as a potential support area because previously it was resistance. And if you're looking for opportunities, I think which is a question HH Hassan has just asked us, easier opportunities. I think easier opportunities are always in the markets that are trending. Think about it. In trending markets, you are automatically giving yourself a better chance of making a successful trade, regardless of where you get in, simply because you have momentum behind you. Secondly, trading in the direction of the trend gives you lots of opportunities to come out of a losing trade, or gives you lots of opportunities to turn a loser into a potential winner, which is not the case if you're trading against the trend or if you're trading in sideways markets. So just by concentrating on the markets that are trending, you will automatically give yourself a better chance of making more opportunities. So I would say concentrate on the indices because they have been trending higher rather than FX. FX has been all over the place. And when there's more direction in FX markets, then obviously you can concentrate on those markets. But right now, the trend is your friend and the indices, and I expect this trend to continue for the DAX and the support area. I expect it to hold. If it does, then we may see a continuation to the 161.8 extension of this Fibonacci retrace that we have drawn here. Already it has reached the 127.2 extension. The next logical target would be the 161.8. Victor, if you're still with us, HH Hassan has asked, which sectors would you expect to prosper in the near future? Would you like to take that question?
Oof.
Sorry to put you on this one.
No problem. It's a difficult question as we have this wave of the Delta variant storming through the economies globally. So I would stick to tech really, because it's resilient to all these scares. And but that said, this trend has been pretty strong, especially for the top 5 companies: Apple, Amazon, Facebook, Google, so-called FANGs, Netflix.
Look at this. Well. Apple just broke to a new record high yesterday. Big breaker.
Yeah. They are at all-time highs, and to be honest, like the only thing that can impact this trend is for some legislation on part of U.S. lawmakers attempting to curtail their monopoly powers. However, I don't see that happening anytime soon. It seems very difficult at the moment, just because of the powers that the lobbying powers that these companies have in Congress, really.
Yeah, just where you were talking there, Victor, I saw this beautiful hammer candle on the daily chart of Amazon, which should be very interesting to monitor in the next few days. It looks like a big reversal, bullish reversal for Amazon shares. Attempt to break below the 200-day moving average. This is something on the side note, guys. I have discussed in one of the videos I've created on YouTube for Think Markets. A false break below the 200-day moving average. Please, if you get a chance later on, go to YouTube and go to Think Markets. Go to the playlist that we've created. There is trading the failure of key reversal patterns. Yeah, there's lots of videos in this, and in this series, I have discussed how to trade the failure of key technical patterns like candle patterns or chart patterns, etc., etc. I've also discussed the failure of the 200-day moving average breakdown. These videos are like only 5 to 7 minutes long, so you could watch all of these in a few hours. But this is a typical example of what I've discussed in this video. So make sure you watch that. Let me just share the link for you guys in the chat.
So HH Hassan is asking us to have a look at the Canadian stock market.
Canadian stock market, okay. Yeah, we don't usually, but let's have a look. Yeah.
Sunday market wasn't it? Market open on Sunday.
Do you know the name of the index? I don't even, to be honest,
yeah, it's just a second. It's the TSX, right? Yeah. SX.
Must be that one, right?
Yeah, I guess.
So this is the Canadian stock index. Apparently, I've never looked at this market, to be honest. I typically just look at the major US indices, Europeans, and a few of the Asian indices. But yeah, it looks very strong. Does that mean it will continue? Remains to be seen. Like all the other world indices, we are coming up to some major extended levels. There's nothing to say that it can't continue, but you know, to be honest, I don't monitor this market very closely to have a very strong opinion on it. But if you'd like my technical views on it, the trend is still bullish. The index is making higher highs and higher lows. And unless that changes, there's no reason to turn bearish on this market. But it does look very extended, and if you look at a few indicators like relative strength index, you will see that the index is near overbought levels and it's starting to make a divergence in terms of the RSI making a lower high while the index is making higher highs. Possibly suggesting that the pace of the rally is weakening and that you should proceed with more caution here. This in itself is not a sell signal per se. It's just a caution that the trend may be weakening. But beyond that, I really don't have anything else to add on that. Do you, Victor, see anything in particular?
No, not really. You have to take into account that there are a lot of commodity stocks in Canada.
Yeah.
that could have an impact if and when the cycle turns. As we mentioned in the beginning, some macroeconomic data is suggesting that this might be happening. However, broad market sentiment is still very strong.
Yeah.
And unless that deteriorates materially, there is little reason to try to attempt short positions here.
So there's a follow-up question from sorry to cut you. A follow-up question from Hashish Hassan. How would you trade it? I mean, if you're trading in the UK and Europe, you can trade it via CFDs. That's where your question is. I don't know what the instruments available to Canadian citizens there are in terms of trading the Canadian index. But if that was your question, in terms of if you're asking, would you trade it long or short? I would say I would look for long or bullish setups than bearish, given the underlying bullish trend. Yeah, but sorry, I don't have too strong a view on this market, as I already mentioned, because it's not something that I normally cover. Let's have a look at a few cryptos. Cryptocurrencies have been coming strong, coming back strong. Bitcoin has been pushing higher ever since it came out of this consolidation phase when it broke the resistance trend of this triangle pattern to the upside. Since then, it has been making higher highs and higher lows, breaking through some key resistance levels. So where do we go from here? It looks like Bitcoin is possibly heading to 50,000 next. Although at the moment it is testing this resistance area between 47,000 to 50,000. Will it get to the top upper end of this resistance area? Is the key question. There's no reason why not, given the bullish trend and the fact that lots of people continue to see Bitcoin rising to crazy levels like 100,000. I don't know if it will ever get there, but that's up for debate. But yeah, just to draw a couple of Fibonacci retracements on this. The 61.8 retracement comes in just ahead of the 50,000 at 51,100. So it is testing resistance, but the fact that it's holding below that, it's I would say it's a bullish sign. We haven't seen any breakdown in the market structure of higher highs and higher lows. So if I put another line here, this was the last low Bitcoin made prior to its most recent up move. That level is now the line in the sand. So let's call that invalidation level. If it breaks 43,700 at that point, Bitcoin's current bullish trend will have come to an end. So long as this level holds, any short-term dips are continuing to be supported, as we can see. Let's see if Bitcoin now breaks through this resistance zone on the daily chart. And in terms of other cryptos, Ethereum or Ether is likewise testing its own resistance zone here. But like Bitcoin, it is not going down much. Well, it hasn't gone down much so far, suggesting that a breakout is likely to take us to 3,800, which is the 78.6% retracement level of the most recent significant downswing. Above that, the previous high comes in at 43,800, and then beyond that, if we get to those levels, then 5,000 rather is the next upside target for Ethereum, which comes in just below the 127.2 extension of the Fibonacci retrace from Fibonacci extension. A few of the other ones that are making significant progress, including this one, Cardano. It's looking quite strong. Remove drawings. It's very close to its previous high. It looks like it's going to take this level out at 249. Sentiment towards the cryptos have turned positive once again. Will we see this similar kind of moves that we have seen in the past with all the regulation and everything else? I'm a bit doubtful, but we may see altcoins do better than Bitcoin, because Bitcoin is quite expensive, and probably for people who are late to the party, they will look at Bitcoin and ask themselves how much they could make from Bitcoin in terms of return compared to some of the altcoins. I think more opportunities are on the alts, so we may see more inflows into things like Ether and Cardano and whatnot. So I'd monitor these ones more closely than Bitcoin. Are there any other questions, guys?
Yeah, well, apparently that concludes it for this webinar. Stay safe out there, and have in mind that we have some important comments from Chair Powell coming up. So
Indeed.
That's something that could move the markets materially.
Before that, we have retail sales.
Sounds more hawkish than expected.
Indeed. That's always the key thing to look out for. So those are the two key macro events happening today. We have industrial production as well. Then it's all about RBNZ, as we mentioned at the start of the webinar. Will they hike is the key question. I doubt they will because of the lockdowns, but we shall see. UK CPI is tomorrow, and so on. Until next week, same time. Take care, guys.
Actually, I'll take the other side of this and say that perhaps the RBNZ will stick to their guns and hike rates.
Okay. There you go, guys. Victor has been
you
spot
can
on.
always have at least two viewpoints on the market.
Indeed. Must say that Victor has been spot on with his calls this year. So if you wanna place a bet, I'll say go with Victor, with Victor's opinion.
Oh no, don't.
Take care, guys.
All right.
Have a wonderful day.
So you too. Cheers. Bye bye.
Thank you. Bye.